Hi guys, Gail Sylvester here. Let's talk about penalties. What do you know? What don't you know? And what do you need to know? That's going to be the topic of conversation today. So when you're in a variable rate mortgage, we're going to talk about that penalty. If you're in a fixed rate, we're going to talk about that penalty. And so that way you know what's going to apply to you. The biggest thing I can say is don't let the penalties or the thought that your penalty is going to be super great deter you from making any future plans. I always say find out. Knowledge is power, and the more information you have, the more of an informed decision you can make to make any sort of move or any sort of change that you're looking to do. So don't feel stuck, right? Nothing worse than feeling stuck. So let's talk about the variable rate mortgage because it's the simple one. If you are in that type of product, it doesn't matter who your lender is, the maximum you're going to pay is a 3-month interest penalty. And that's going to be based on your discounted rate with most lenders. The odd lender does not apply the discount to the penalty when it comes to that. They'll just charge it based on prime. But majority of the lenders, your discounted rate is what they're going to use to charge that 3-month interest penalty. So that's your variable rate mortgage. It's not as great as you think. That's the biggest thing I'm going to say, okay? So let's take the calculator. If you have a mortgage of say 400,000 and your interest rate right now is prime minus 1%. So prime is at 4.7. So if you're at 3.7, then we know annually it's going to be a penalty of 14,800, but that's annual. So when we divide that by 12, we get a monthly of 1233. And if I times that by 3, a 3-month interest penalty for you is $3,700. Not that great. It's not cheap, but it's not great. And it's actually not that bad. So I would make a decision based on $3,700 in equity to make a move that I'm looking to do because it's going to benefit me and my family, right? Other option is a fixed rate. If you're in a fixed rate mortgage, they're all calculated differently depending on the lender. So it depends who you're with. So if we're talking about a bank and or credit union, majority of them are going to charge you a penalty based on their posted rates. So they have a pre-discounted rate. It's not the contract rate you're paying. If you have a contract rate, let's use easy numbers, of 3%, chances are their posted rate is 5.5%. So when you go to break that contract, they're going to use that 5.5% as the guide to charge you a penalty. And it's for the remainder of the term based on that spread of interest calculated against your balance. That's called the interest rate differential. That's long-winded. There is like a scientific calculation behind it, and every lender is going to do that differently. If you're with a mortgage lender, which we call as a monoline lender, they don't have a posted rate. So the contract rate is their rates. So what they're going to do is charge you the penalty based on their current rate and your existing rate. Here's the big thing you need to know. As we're in this interest rate environment, if you had taken a fixed rate, say 2 years ago, your rate's at around 2.5%. Now, as the interest rates have been on the rise, so now it's actually more beneficial for the lender to reinvest at a higher rate. You're just going to pay a 3-month interest penalty, potentially, based on the contract, because it's now as interest rates rise, penalties decrease. And then as interest rates increase, penalties decrease, because what's happening is it's the spread of interest rate. It's that weighted scale between the two that we use as a guide to figure out what that's going to be. We always contact the lender to find out the exact numbers, but at least this way, it's giving you an idea. And since we're at that time where interest rates are on the rise or have been on the rise, interest rates today are actually more expensive. I'll put in air quotes there, compared to what we did get. Based on that, chances are it's just a 3-month interest penalty that you're going to pay to break your contract. So it's not actually going to be that high. So if you were one of the ones that actually locked into a fixed rate today because you were worried about where rates were going, so let's say you locked in at a rate of say 5.5%, say in 2 years, interest rates are back down to say 3.5%. Let's just go there as a guide. So now what's happening is there's a 2% decrease in that interest rate, and you're like, I want that one. Well, now what happens is the lender's going to take a larger penalty because what's happened is they've already reinvested your money at that 5.5%. So penalties are now going to be a lot larger than that standard 3-month interest penalty. There's a lot behind it, but this is just an overview of what you can expect based on where your interest rates are or what your contract is. If you're on a variable rate, you're golden. If you're on a fixed rate, you could be, depending on when you locked in, But if you've just locked in now and you want to do some changes, that's where we're going to have to figure out what's going to be the best bet for you. That's your Coles Notes version of what you can expect with penalties. And hopefully that helps give you a little bit info. And if you have any questions about you, reach out. We're happy to help.